to episode 77 of the AMT podcast. Before we start, I'd like to remind you all about my newsletter. The podcast is dedicated more to lessons I share on trading and chats with other traders. But the newsletter is more of a peep into my day-to-day life, the struggles, the highs and lows, my profits and losses, and my thoughts on recently trending events. In addition to that, I also have a premium letter where I do write-ups for big events, video tutorials on strategies I execute, and you also get access to my Discord channel where you can chat with me and other profitable traders where we often share positions that you too can follow. I'll leave links in the description below, and I look forward to welcoming those who join. If that's not for you, then I do hope you continue to enjoy these videos. Back to the episode. So today I want to talk about the psychological aspect to scaling up your profits. Last week we spoke about why profits tend to snowball after 10K. But there is a caveat to that. Getting from 1 to 10,000 demands that you groove a new set of habits pertaining to expectations and consistency, and fending off temptations or extenuating circumstances which could hinder, slow down, or even undo your progress. Now, once you've passed that, assuming you did it properly, you have not just a set of good habits to spur you on, but you also have momentum. So the same percentage return generates a bigger numerical amount for the same effort. That's the power of leverage. Now, whilst the math might make sense, in practical terms, it's not so easy. And there's several reasons for this. The second wall. So past the 10K region is where the majority of people can at least entertain the idea of replacing their salary. Now, of course, this varies a lot depending on an individual's ROI. At some point, however, every trader gets to a place where they hit a wall again. And for me personally, that was around the 50K region. Now, this is a very different wall from the one you're trying to climb when you're getting from 1 to 10K. That's when you're just trying to stay alive. But 10 to 50K is arguably the most exciting phase of growth. It's where you're in cruise control and the numbers aren't big enough to throw you off. After a certain point, however, there comes a time where the rationality of scaling does not equate to the reasonability of doing so. So what do I mean by that? Well, I didn't start consistently staking 3-figure amounts until I got to around the 5K region, so around 2%. I could afford to bet with £100 stakes or bigger consistently past that. But at 50K, that's where my threshold crossed over into the 4-figure territory, where my plan allowed me to stake up to £1,000. Now, I'm not saying I hadn't ever staked 4 figures till then. I didn't follow a neat, perfect plan to get to that level. I blew up many times on the way, namely because I was staking 4 figures way too early. There's a distinct difference between unintentionally stumbling into a 4-figure trade because you're revenge trading and planning to do so. And it's an awful lot harder to pull the trigger when your bankroll and risk management literally allow you to do that. And I remember the anxiety I felt around that region. I remember the pressure I used to feel. I remember cutting trades too early, hesitating to take positions, second guessing myself, and it was just a nightmare. It felt like all the early bad habits that I overcome had come full circle again, and it felt like I was losing my edge. And it felt irrational because I wasn't doing anything different from when I was staking £100 with a $5,000 bank. So what was the issue? Why it happens? Well, at face value, there was a few. The first being that the market and style of my trading was not appropriate for it. The methodology of your strategy has to be suitable for scaling. For example, horse racing, it's too illiquid to handle 4-figure stakes in play. I've only managed to do it a handful of times, and I could only do it on the big festivals where liquidity is 10 times higher. Putting 4-figure stakes through the market during a midweek race at, say, Carlisle was just not a viable option for me. Liquidity is too thin, and when I tried to scale up, I found myself having to chase my exit price for worse value and locking in a loss on a trade which ordinarily would have broken even because there wasn't enough money to get matched. Now, pre-race is more liquid, but I ran into the same problems. Past a certain level, my staking would just stick out like a sore thumb. The market would be aware as to what my intentions were, and the market would just try and front run me and move the price before I even got matched. Unfortunately for me, I'm not good enough or confident enough to stake big in play. Now, there are traders out there who are happy to stake a high 3-figure or even a 4-figure amount in play, but they are a lot more confident in taking a longer term horizon in their forecast because they have a better edge than I do. So whilst they might run into the same problems as I would when it came to exiting a trade, because they are earning a substantially higher ROI on their winners, it more than offset the losers. Now, in 2020 cricket, I had different issues when it came to scaling. Cricket is super liquid. You can put tens or even hundreds of thousands through the market without issue. The problem for me though is that I use a lot of short-term strategies combined with my longer-term plays. Now this is significant because when I stake in the £300 to £500 region, if I'm wrong and I lose say half my unit, I could make most of that back or even still turn a profit by scalping pre-match and halftime, or take short-term in-play positions over by over when, say, the run rate was slowing down, or if the prices had overcorrected during a price-sensitive situation. So these short-term strategies alongside my long-term plays were crucial to my consistency and profitability. At higher stakes of, say, 800 to £1,000, those short-term strategies would no longer cover my long-term plays if they lost. So as someone who prefers racking up smaller and consistent wins, when my profit and loss tally turned patchy, it knocked my confidence. So I overcame that barrier by no longer increasing my staking in a linear fashion. Instead, I would increase my stakes in small increments. So instead of betting 2% of my bankroll, if I was staking, say, £500, I would go up to £510 or £520. That way I could scale up slow enough for my brain to not notice and cause my decision making to go haywire. Another adjustment I made was to just simply switch off the ladder interface when taking bigger positions. There's nothing more anxiety inducing than constantly looking at the prices when it's not necessary. And since the tick increments are larger with bigger stakes, the temptation to make a bad decision is even higher. So by not looking at every micro price move in play, it helped create that distance or separation from the bet, and I could focus more on the action at hand. I was effectively treating my bigger stakes on long-term positions like investing. So when I accumulate Bitcoin, I'm not looking at the price every day or every week, otherwise I'd go crazy. But because my confidence is anchored in a long-term view, I can stomach some of the whipsaw along the way. So scaling isn't as simple as just following the math. Your methodology can top out or bottleneck if you run into liquidity issues, or your decision-making can be impaired if the stakes get too big. Increasing your stakes incrementally or just switching off the ladder face were just a few tricks that I used to mitigate that. But this still begs the question as to why we even feel pressure when staking bigger, even if it's in line with our bankroll. And this brings me on to my next issue, the psychological barrier. Now, this is probably the hardest part to quantify. Now, I'm not exactly qualified to speak on this. I'm not a psychologist or anything, but upon introspection, I have my own theories as to why this happens. So I'll do my best to explain it. So money is innate. It has no emotions. It's just paper or numbers on a screen. Whether it's £100, 1,000 or 1,000,000, money has no emotion towards us, but we have loads of different emotions towards money, which change depending on the amount. We all enter the trading arena as adults with different experiences with money. Some of us grew up abundantly, some of us grew up frugally, some were handed it, some had to earn it. We've all handled different amounts, and consequently we've established our own comfort zones. But prior to trading, I never had 5 figures in my bank account, and maybe that was a reason why I went round in circles for so long and kept blowing up before I finally hit 10k. At 50k, I was entering 4-figure staking territory after years of staking 3 figures. When someone like me thinks of £1,000 or 4 figures, I think of rent money, I think of bills, I think of almost a week's wage, or buying a new set of golf clubs. And the prospect of potentially losing that in minutes or hours was very uncomfortable for me in the beginning. Now, someone with a lot more money than me, or someone who's used to handling larger amounts, might think, that's pocket money. I bet that on a coin toss, or I could make that back in 5 minutes. So we're all phased and triggered at different thresholds, depending on what we've been accustomed to handling. So before staking 4 figures, I was absolutely unfazed by a £200 or £300 loss. That was my comfort zone, but that would be a bloodbath for someone else who's not at that level. I know that if I lose that amount, I could make that back in 1 or 2 good trades. Losing £500 or £1,000 was uncharted territory. And this is the problem that comes with staying comfortable at a level for too long. Plateaus are inevitable, but I believe you should always make a conscious effort to be uncomfortable and strive towards progressing, even if it means taking the smallest steps. If you stand still for too long, you create a comfort zone and you paralyze your ability to get to the next level. So as I mentioned, I had to play various tricks on my mind to get past those self-imposed barriers, like increasing staking incrementally so I wouldn't notice, or just closing the price ladder so I could detach myself from the short-term moves, until I slowly built the mental muscle needed to handle bigger amounts. So whilst the math behind scaling up is rational, our minds aren't rational. We all have different pain and trigger points, and you have to do whatever it takes to break past them, even if it means slowing things right down. Extenuating factors that hinder growth. So as if the mental demons of scaling up is not challenging enough, there's variables beyond your control which will pose a sustained challenge to your trading performance. And one of them is dealing with the ebb and flow of a trading calendar. Opportunities do not arrive consistently. There will be periods where dozens and dozens of opportunities just fall in your lap and you can't help but make money. Suddenly you think you're a genius and you start projecting how much you'll make in the next 6 months or a year if you keep up this rate. And this is a classic trap so many fall into. What you made last week or last month has no bearing what you'll make in the future, because opportunities are not evenly distributed. You're often not as good as you think. You've just taken advantage of favorable circumstances, and many traders confuse the two. Because trading well isn't just about making a lot of money. It also means not losing money during lean patches, of which there will be many. And this is why successful trading demands humility at all times. You can never afford to let your guard down, because you're only ever one trade away from undoing everything. No matter how well things are going, you always have to exercise live caution and know where you are on that ebb and flow of the trading calendar. Knowing what markets or events are your strengths and weaknesses can go a long way in mitigating that. And I believe for that reason, it takes a good few years to really fine-tune your trading timetable. You have to trade the same event or market several times in order to know where your strengths are and where you're bleeding money. And even when you do figure that out, the nature of change means you can never afford to rest on your laurels. If you're relying on stale data and not evolving, the market will catch up, and even if they don't, sometimes the law will. Which brings me to my final point, which is the changing macro environment. Unfortunately, there's factors beyond our control which we also have to be mindful of. The future of gambling, gaming, and trading is a forever changing mosaic in the eyes of the law, and this poses a constant threat to our ability to earn profits uninterruptedly. I've done episodes in the past discussing government overreach, corruption, hiking taxes, and invasive affordability checks. You have to be aware of developments at a macro level. Horse racing, for example, has been one of the sports that's been hit the hardest in recent years due to affordability checks. And government's latest proposal of potentially hiking gambling taxes even further is only going to cause more damage to the industry. So those who've been on top of their game and have been trading or betting on racing profitably for many years are now having their livelihood under threat by factors they have no control over. In India, only 2 weeks ago, the government have outlawed online gambling. Banks and payment providers will face financial penalties and potential jail time for processing transactions. Now, Indian punters are largely responsible for providing vast amounts of liquidity to the cricket markets. And there's now a chance that they'll be forced to bet underground with illegal, unlicensed bookies. So how this affects the liquidity pool is yet to be seen. In the cryptocurrency space, in 2017, when I first opened my account in the UK, it was the cowboy days where KYC checks were minimal. There was no deposits or withdrawal limits. It was also a gray area legally, at least tax-wise, since governments didn't know how to class it as a currency or an asset class. The ease of access to derivative instruments also meant that there was a lot of flexibility to trade it with virtually unlimited levels of risk. Now, fast forward only 6 years or so, and the landscape has completely changed. Exchanges now conduct invasive privacy checks where they want to know every bit of information about you. Up to a certain point, deposits and withdrawals now raise red flags and are often delayed by days. If you want to trade with derivatives now, you often need to prove that you're professionally qualified or prove your net worth. And the worst and arguably most sinister development in this space was when the banks completely pulled the plug on crypto exchanges without even notifying customers. So I had some money stuck in some exchanges in the UK for months, and I had to find private buyers just to offload my crypto. Many exchanges have now subsequently just stopped operations in the UK altogether now, which make trading it completely unviable. And these are just things which you can't forecast or prepare for. And this goes for almost any asset class you want to trade. There is always anxiety that comes with trading, because not only is tomorrow's opportunity never promised, the ability to even trade isn't either. Changing fees and taxes, changing laws and regulations, or change of a company's direction in the stock market. There's so many variables that you can't account for. It's impossible to put a time frame on where you can ever expect to be. And it's why it's so important to always forecast over a longer time horizon, or at least be conservative with your projections. And that way you relieve yourself of any unnecessary pressure. So in summary, the psychological aspects which I've detailed pose a challenge to every trader at some point, whether you're trying to get to 10K or whether you're trying to get to 1 million. Whilst the math behind scaling is rational, our emotions aren't. At the end of the day, we're human, and screwed up ones with complex emotions and different relationships with money prior to trading. Accept that. Don't fight it. But if your decision making is suffering at the next level, you don't have to scale in a linear fashion. You can do it incrementally, or just do whatever it takes to keep putting one foot in front of the other. There's nothing wrong with hitting plateaus, but you have to do everything in your power to break past them. Much like running a business, problems always arise. It's never smooth sailing in this game. But if you're prepared and ready to pivot, then you are going to make a lot of money over a long time. So hopefully you found this episode useful and informative. Don't forget to like, share, comment, let me know what you think, and I'll see you guys in the next episode.